Welcome to Whole Life Insurance Mechanics from the perspective of Nelson Nash's infinite banking concept. I'm your host and lecturer, Ryan Griggs. This is part 3 of our 7-part series, and today we are talking about modified endowment contracts and term riders. Let's get into it. Here's our overview. So when I say MEC, M-E-C, Modified Endowment Contract, right? We're going to refer to that as a MEC throughout the course, and that's what you'll hear online. So whenever you see that abbreviated, MEC is what we're talking about, Modified Endowment Contract. We'll start by defining it. We'll go into the consequences of MEC status, what it means for a policy to be a MEC, practically in terms of what it means for you, the policy owner. We'll then mention the 2 ways to prevent MEC status. And you can sort of tell the 2 ways are premium structure and a term rider. So we'll talk about what we mean by premium structure. We'll go into a bit of the language that's very informal, but I'll kind of give you a preview so you know what to expect when you're poking around online and talking with an advisor. Why term riders are used? Well, it's to prevent the MEC, of course, but we'll talk about term and the 3 types. Right, there's a lot of discussion online. Should you use term? Is term good? Is term bad? And rarely is the idea of a term rider disaggregated into the 3 types of term. Right? Not all term is created equal. It could be that some term is efficacious, advisable, and that some term is not. And so we'll give an overview of the various types. I, of course, have have a view on the ones I like and the ones I don't. You can come to your own conclusion. We'll talk about potential consequences of some term riders I'll use an example of a letter that a client provided me. He had a policy with a particular kind of term rider on it, and he got a letter from a company that demonstrates some of the consequences that we're going to review. And then answer the question, is term even necessary? And look, I want to preface this too by saying that this course is long enough. I could, but I'm not going to get into the history behind essentially the development of constituent elements of dividend-paying whole life contracts. Okay, 50 years ago, there was no term rider. 50 years ago, there was no PUA rider. Okay, so the modified endowment contract thing, the MEC beast, is a consequence of various tax quote-unquote reforms, being polite, in the mid to late 80s. That's why we have this idea of MEC status. And it's also, to an extent, why we have certainly term riders, but then why we even talk about premium structure in general. So we're not going to get into that history. I'm just going to tell you how it is now. And in the notes or at another place, I can provide some links and maybe do another talk in the future explaining some of that history. But this is just the way things are now, so that, again, you in your process of coming to the table to talk to an advisor, to buy your first or your next policy, know what the landscape looks like. And hopefully that'll help you come to some well-informed, reasoned conclusions about what you prefer and what you don't. So, what is a MEC? A MEC has to do with the tax system. Okay, it's a tax status, and there are unfavorable tax consequences. Okay, so sometimes we'll talk about an unfavorable tax treatment or an inferior tax treatment. That's really what a MEC is. And by the way, this has big implications in the event that a nonprofit entity owns, meaning a non-income taxable entity owns dividend-paying whole life. That happens to be a MEC, right? If a whole life insurance contract is a MEC, that whole life insurance contract is therefore receiving unfavorable tax treatment. Well, if the entity owning the policy doesn't pay income tax, then there's an idea that perhaps the MEC status in that context is toothless. Right? The policy would still be a MEC. It is what it is. That's the status. But if the consequences of a MEC have to do with income tax changes, and the owner of the contract is an entity that doesn't pay income tax, well then, what there, maybe there's not really a consequence to that. So there's a lot there that we don't talk about much in the IBC world yet. I believe we will. If you own or not, well, if you're the key decision maker, let's say, of a non-taxable entity and you're interested in IBC, I would like to hear from you because a lot can be done. But anyway, back to the subject here. So what happens if a policy is a mech? Well, let's consider the idea of when your cash value in a contract exceeds your cost basis. Okay, cost basis essentially is the same thing as what we might call your cumulative premium. Cumulative premium. So this is a tally, essentially, of the total premium dollars paid into the contract since day one. Okay, that's your cost basis. The term cost basis comes up when we talk about taking dividends as cash. Remember, dividends are treated as a return of premium, which is a non-taxable cash flow in IRS terminology, so long as you haven't received in dividends more than your cost basis, right? In other words, you can receive dividends in cash without triggering a taxable event, so long as the total amount of dividends received does not exceed the total amount of premium you've paid in to the contract since day one. Put differently, you can receive dividends in cash up to your cost basis. Dollars received in dividends beyond the cost basis become income taxable. Nelson Nash, in Building Your Warehouse of Wealth, tells a scenario about with his State Farm policy that he got in 1959, how he was in order to demonstrate to people the magnitude of these dividends, he told the company, look, send me a check so I can show people the checks to tell them that this is real. You can do this. And he did that. And then the company asks him at the end of, I think, 3 or 4 years, the company requests his confirmation of a Social Security number because they're going to send Nelson a 1099 because additional dividend checks received as cash beyond the cost basis. He had reached his cost basis. He had received in dividends everything he had paid in since day one would then trigger tax. So that this is the consequences of a modified endowment contract appear or become manifest when our cash value, our equity in the policy, exceeds our cost basis. In other words, when we have a gain, when our equity is greater than what we paid in, greater than our cost basis. In the event that happens, and in properly structured life insurance, which we're explaining what that term, in a sense, this whole course is dedicated to explaining what that means. But in a properly structured whole life insurance contract built for the IBC, cash value will eventually exceed the cost basis. And when that happens depends on when you get the policy, how it's structured. We're going to get into all that later. Trust me. Take it just for now. Just understand that cash value will eventually exceed cost basis so long as you pay premium and so long as the premium is structured correctly. Well, when your cash value does exceed cost basis and you take a distribution, and that can be any kind of distribution. Okay, it can mean doing a partial surrender. It can mean taking a policy loan. Any kind of cash payment to the policy owner when cash value exceeds the cost basis in a whole life policy that is a mech, those distributions become income taxable. This is sometimes referred to as LIFO, last in, first out tax treatment, right? As opposed to FIFO, first in, first out, right? The ordinary tax treatment of dividend paying whole life is FIFO, first in, first out, meaning that you can receive back everything you've paid in. Right? The dollars you paid in first are considered to be the ones that come back to you when you take a cash distribution. Right? First in, first dollar in is the first dollar out. And you can receive that dollar out all the way up to your cost basis. Okay, whereas with LIFO, last in, first out, the dollar you most recently paid in, that's the one that's considered to be coming back out. So if I have a gain in the contract, and my recent premium payment ostensibly contributed to that gain, and then I take a distribution, well then, from the IRS perspective, under LIFO treatment, that dollar I'm receiving back is a dollar of the gain, in a sense. And because I'm then realizing a gain of some kind, we trigger a taxable event. Okay, that's, again, I'm not a tax advisor, but that is generally, and you're going to hear LIFO online at some point, I'm sure. That's what it means. Right? It means that once cash value exceeds cost basis and you take a distribution, you're triggering a taxable event, which is not good. I have down here, consider policy loans late in life. Well, late in life, you've had the policy for a long time, you've paid premium for a long time, cash value's had a long time to grow. You're going to have cash value is going to exceed the cost basis. So if you start taking distributions at that time, well, those could all be taxable cash flows. And that's not the end of the world. Nelson used to say this is not the end of the world, and it's not. We're solving for the banking function. We're solving for control over and access to capital. You can still do that in a mech. You're just doing it less efficiently because there's tax involved. So we certainly don't want a mech, right? So yeah, it's not the end of the world, but no thanks. No thanks. And another rule, this applies to annuities and other tax qualified plans. If you take a distribution involving a policy, but while the policy owner is less than the age of 59 1/2 years, then there's an additional 10% penalty on top of the tax. Okay, so nobody wants that. And modified endowment contracts are irreversible. There's typically a grace period, so people really worry. I have clients who, and this was earlier on. I think we've put more information out through Banking with Life and on the my blog and so forth. Other people too, where it used to be that sort of a primary concern was I don't want to mech my policy, and I don't want to downplay that threat. Like it's certainly it's a serious tax status change, so it's worth being concerned and aware of. But there are there should be many things in place to make sure that doesn't happen. Okay, one of those many things is this idea of a grace period. Companies know that it's potentially not in your best interest for an individual to have a whole life policy that is a mech. And so they'll let you know if you've made a payment that's caused the policy to become a mech. And they'll often reverse that transaction. And my understanding is the law allows for a reversal in the transaction that triggers a mech. But if the reversal is not made, say, within 30 days, and I don't know the exact, it might vary state by state, but if it's not made within the specified grace period, then mech status is permanent. So there's no undoing it down the road, which just sort of makes it all the more urgent to avoid it. A lot of what goes on with modified endowment contracts is what drives structure. Both the structure of the policy in terms of the riders and and how the premium is allocated across base and PUA. It's a lot of what drives it today. So, where in a sense the industry is responding to potential tax status threats with the use of term riders and allocation of premium across base and PUA. A lot of that comes from the problem of the mech. And so that, prior to the 80s, when we got modified endowment contract rules, like I said earlier, there was no such thing as a premium structure. You paid one premium, it was base premium, and if the company had a financial surplus at the end of the year, they paid a dividend, and that dividend went to PUA. And that was it. And a lot of the policies that Nelson got prior to the last 30 years of his life were base only contracts because that's all there was. Right? Now, this was a time when interest rates were higher, therefore investment yields to insurance companies were higher, therefore financial surpluses at the end of each year at these companies were higher, and therefore dividends were higher. Okay, I mentioned this, it's relevant in becoming your own banker. which was published originally in the year 2000, the version we see now, the 5th edition, as of the recording of this video in April 2022, is the 5th edition, and there's a 6th illustration in Part 4, Equipment Financing, right? Illustration number 6. And Nelson has some text where he explains that agents complained, what a surprise. Agents complained that the pace of cash value growth shown in illustrations 2 through 5 couldn't be achieved anymore in the new millennium, because interest rates had come down, investment yields to companies had come down, dividends had come down, and so the pace of growth in cash value was slower. And so Nelson said, well, in an environment where interest rates are down, the thing to do is capitalize more, which is why in illustration 6, he shows an additional 5th year of maximum PUA premium payment. And by the way, if you follow that logic through and consider that interest rates are lower now than they were in 2010, well then, wouldn't we want to pay even more premium to capitalize even more to offset the problem of low interest rates? And by the way, aside from all of this, wouldn't it be a good idea to always capitalize anyway? Yeah, I'm getting ahead of myself, but look, a lot of this, my point is, a lot of what happens with structure comes from the modified endowment contract and has implications as far as interest rates and dividend schedules and all that. But good. Thanks, Lucy, for the slobber on my jacket. Thank you. Okay. What causes mech status? Again, this gets a little bit into the history, but essentially in the 80s, interest rates shot to high heaven. Nelson even mentions it as part of his own story in discovering the infinite banking concept. Well, it turns out that about the same time, early to mid 80s, very wealthy people were buying what were called single pay whole life insurance products. We talked about it in the prior lecture. And the cash value, because interest rates were so high, dividends were so high, cash value growth was what it was then, very high. Someone could pay one premium, and that one premium would fully pay for the death benefit. That initial death benefit would be fully paid up. Remember our paid up, paid for terminology. Consequently, if something's fully paid for, the value is high and cash value grows guaranteed with those 4 factors that we talked about. So the cash value growth would be tremendous. And so someone could take a policy loan. Policy loans are loans. They're not income, so they're not income taxable. And what really occurred was a bunch of, and I mentioned this further in my 2019 talk at the Nelson Nash Institute. It was called Why Nelson is an Heir to Menger. I'll link to it elsewhere, but Why Nelson is an Heir to Menger. Heir, H-E-I-R, to Menger. Menger being the founder of the Austrian School of Economics. I explained a little bit of this in that, about maybe two-thirds of the way through that talk, that what really happened were that providers of term insurance, namely a company called A.O. Williams, which has since been bought by Primerica, I believe, but they sold a bunch of term insurance. And so one way to sell a lot more, they're the originators of this idea of buy term and invest the difference, right? The difference being the premium you would have paid to whole life. Instead of paying that big old premium to more expensive whole life death benefit, use that money and buy temporary death benefit, which is much cheaper. And then the difference between those two premiums, take that money and go invest it in our high load mutual funds, of course. But another digression. My point is that in the 80s, people were buying whole life. The accusation from the term providers was that because cash value grows without tax interruption, without taxation along in the growth along the way, and because that money could be accessed on a tax-free basis, all of this we'll get into later, by the way, the term providers complained to Congress and said that, look, purchasers of dividend-paying whole life are decreasing tax revenues. Such a joke. And the result of that were these modified endowment contracts. And so the goal was, with the creation of MECs, to prevent too much cash value growth too soon, right? In order to, in a sense, relatively disincentivize people from buying these policies to build this cash value in a tax-deferred, technically tax-deferred, but accessible tax-free environment. So the goal with the Mech was to prevent too much cash value. That's my point. Okay, and so if we then say, okay, well, what causes the Mech? Well, what causes the Mech is too much cash value too soon. Okay, too much cash value too soon, and the way that the cash value growth was proposed to be throttled, was to be metered or regulated, was with restrictions on the relationship between the premium and the death benefit. Okay, and that particular mechanism that regulated the relationship between premium and death benefit in order to throttle cash value growth is what we call the 7-pay test. That's the particular mechanism. So on an illustration, you'll see the 7-pay test. On it might even be in your contract, right? The idea of the 7-pay test. Why the 7-pay test? Well, the idea is that total premiums in any 7-year period couldn't, put it this way, if you could fully pay for, if you could cause the initial death benefit to become fully paid up in anything in 7 years or less, that's considered to be a modified endowment contract. Right? Remember, cash value is the net present value of the death benefit. And if I can fully pay for the death benefit in a very short amount of time, like in a single pay policy, like in a 7-pay policy, then I'm generating too much value too soon from the IRS's perspective. Right? We recall the Walmart TV example. That the Walmart TV purchase, that's paid for right away. I pay the $500 or whatever it is. They give me the TV. The TV's fully paid for. If I go tomorrow, the day after the purchase, and return the TV, they're going to give me a refund for the value, right? Meaning that the value of the TV is the $500. I fully paid for the TV, right, in one day. Well, in the context of life insurance, if I could fully pay for the death benefit in one day, well, then the value of the death benefit would be what I paid, right? The cash value would essentially be equal to the premium right away. Okay, and that's what Congress, at the motivation of these, or at the provocation of these temporary term providers, wanted to eliminate, because Uncle Sam is there for you. I kid, but so I hope you can see that that's why, and why 7 years? Like everything, it's arbitrary. Okay, there were people who were testifying at this Senate subcommittee on debt and finance that wanted 5 years. There was others that wanted 10 years. Okay, there were other proposals at the time for how to restrict cash value growth. This is just the one that the Senate and ultimately the federal government at large, because this became law, in all its wisdom, decided was appropriate. Okay, so it's totally arbitrary. But what it means is that in any 7-year period, if the amount of premium paid in could fully pay for the death benefit, well, then in the IRS's view, that's too much cash value too quick. You've generated too much value in the contract too quickly. And if you do that, okay, you can do that. But just keep in mind that if you then go access that value in any sort of way through a distribution, we're going to charge you income tax. That way the federal government doesn't lose out on any income tax. I can't say it with a straight face, y'all. But this is what we deal with. Okay. It's important to note that this 7-pay test is ongoing. Okay, a policy can become a Mech in any year. So it's a 7-year, the analysis is performed on a 7-year period, right? Can the premiums paid over a 7-year period fully pay for the death benefit? That's the question. And then as you proceed through, the first range of calculation is year 1 through 7. In the second policy year, we'll perform that test in a range of years 2 through 8. And in the third year, we'll perform it between years 3 through 9. Okay, you get the idea. Right, so the 7-pay test is ongoing. And sometimes you'll hear about the idea of a Mech Limit or a Mech Premium. this is a premium number that, if paid in a given year, would cause the policy to let me put it differently. If the Mech Limit is a premium that, if paid, could cause the death benefit to be fully paid up. This is why you can't RPU. I'm getting ahead of myself here. We're going to talk about non-forfeiture options later, but this is why you can't RPU before the end of the 7th year. Okay, RPU, reduce pay up. You can't fully pay you can't pay up the death benefit prior to the 7th year. Otherwise, that policy is a mech. Okay? And so the premium, that premium number that would generate sufficient value, that if the policy owner wanted to, could walk away and not pay another dollar to pay for the death benefit, that premium number is what's often referred to as the Mech Limit. Okay. It's another little tidbit here. The Mech Limit can change. Okay, just because the Mech Limit is a certain number across a certain given number of years, again, if I'm 10 years into a policy and I've paid premium and I've generated cash value, right, the question is always, over a given 7-year period, could the next marginal premium payment generate enough value sufficient to fully pay for the death benefit? Okay, so there's a sense in which future premium payment could cause a mech. Okay, and there's ways to prevent it. The ways to prevent it are premium structure and term. I went way beyond what I thought I was going to talk about for this one slide, but I hope you can see this is relevant, right? So to summarize before we move on, the idea of a mech is a policy in which we generate too much cash value too soon. And the way to prevent too much cash value generation too soon is to adjust the premium structure and potentially to add a term rider. What do we mean by premium structure? Okay, so we need to have a little terminological or linguistic discussion here. There is no industry standard for this language. You'll hear things like 1090, 40-60, 50-50. You'll even hear 60-40, okay, 30-70, or 70-30, right? It's a series of two numbers, right? Two-digit numbers followed by another. What's that refer to? Well, it can either mean the percentage of the total premium that goes to base, followed by, well, let's use the same, I'll use a hyphen here, followed by the percentage of total premium that goes to PUA. Okay, so we have, in other words, with 1090, that might mean 10% of the premium goes to the base premium, 10% of the total outlay, 10% of your total payment to a company in a given year goes to the base, and 90% goes to the PUA. Okay, in the example of 60-40, the question is, well, what does that mean? Does that mean 60% is going to the base, 40% is going to the PUA? It's been my experience that when people use this terminology, what they really mean is that 60% of the total outlay is going to PUA and 40% is going to base. So you see, we've switched the order. All right, so what the question is, what number comes first? The percentage that goes to the base or the percentage that goes to the PUA? And that's what I mean, that there's no industry standard for the language. When I refer to structure throughout this lecture series, if you talk with me, if you're a current client, you know this. For me, structure is, we'll put it here, the percentage that goes to base and to a term rider, if there is one, to the percentage that goes to PUA. And I'll put for Ryan here. This is how I refer to structure. So a 40-60 structure, for example, is one where 40% is going to the base and term. If there's a term rider, doesn't always have to be one. But 40% covers base and term premium. 60% of the total outlay goes to PUA. Right. $10,000 in total premium per year. 40% payable to base and term. 60%, $6,000 payable to PUA. Okay, that's how I refer to structure. Some will say, 90-10. What somebody means when they say that is not a policy where 90% of the total outlay in a given year goes to base and 10% goes to PUA. I'm just telling you, that's not what they mean. They mean 90% is going to PUA, 10% is going to the base. So nobody ever mentions this. This is why I made a point to say it, is that there's no formality to it. Certainly it isn't regulated. The market's figuring it out. Okay, the market's figuring out what the appropriate way to refer to this idea of structure is. Again, it's so new. Okay, we weren't having premium structure discussions 40 years ago. So we're adjusting, and that's fine. It's a process, but just understand that there's no set way of referring to these. And then when I speak in this lecture about structure, I'm going to do it this way. Okay, the first number goes to base and term. The second number is the percentage that goes to the PUA. And we can even see a problem. Like, well, if I say 40-60 and 40% goes to base and term, well, we're sort of aggregating, right? Like how much of the premium is going to the base and how much is going to the term? Right, so it's still not super precise. Right? These are just ways, and I've noticed with, like, say, for instance, the 1090 folks, it's not really 1090. It's 10% of the total outlay goes to the base, and then, it might be another 5%, 5 to 10% of the total outlay goes to the term rider, and then the rest, 80 to 85% goes to PUA. Okay, so these are all just proximate ways of talking about premium structure. Now remember, a modified endowment contract happens when we have too much cash value too soon. Remember that PUA premium, this is why we talked about premium earlier. This is why this lecture series is structured in the way it is. We mentioned how PUA premium, because we're buying additional death benefit, that additional death benefit is fully paid for, it's fully paid up. Right there, we're not introducing future costs. We're not introducing obligations for that new incremental death benefit in the future. Therefore, we must be increasing the present value of that now higher future cash flow. Right? Therefore, PUA premium generates a lot of cash value right away. Okay, so and too much cash value too soon can cause a modified endowment contract. Therefore, if I pay too much PUA too soon, I might generate too much cash value too soon and therefore cause a mech. Okay, so the first way to prevent against the modified endowment contract is by structuring the premium appropriately, is by having sufficient base premium and by not having too much PUA. Okay, now I get it. You might say, well, I've got a 1090 policy, and that's a lot of PUA, and my policy is not a mech. I get that. That has to do with the term rider. We're going there. Just understand that oftentimes we talk about premium structure as if it's just a matter of how much cash value do we get. It's like, okay, yeah, that's true, but understand that too much cash value too soon in any given year can cause a mech. And a mech can happen at any year in the life cycle of a policy. Just because your policy is not a mech right now doesn't mean it won't be one in 30 years. Just because your policy is not a mech right now when you pay a high PUA doesn't mean your policy won't be a mech in 20 years when you want to pay that same high PUA. Okay, you can kind of see where I'm going with this. In policies where there is a lot, this 90%, 80% of the total outlay going to PUA, there's a sense in which this idea of structure, we talk about premium structure, it's so static. We're talking about the structure in year one. How much PUA, how much of my total premium outlay in a given year can I send to PUA in the first year? Like that's often what we mean, what people mean when they talk about structure. Because a 1090 in year 1 ain't going to be a 1090 in year 25. Let me tell you that right now. Okay, there's a sense in which this structure has this connotation of like fixity, like the structure of a building is what it is. Like the building is like sort of defined by the structure. So as long as the building's there, so is the structure. Well, that's not the case with life insurance. Okay, just because we've got a 1090 structure or a 2080 structure or whatever it is in year 1 does not mean that's what the structure is going to be in a later year. In fact, a 50-50, take a 50-50 structure. 50% of the outlay in year 1 goes to the base. 50% of the outlay in year 1 goes to the PUA. Look, eventually that PUA is not going to be payable. Eventually, continued payment of PUA will cause a mech. There will have to be a pullback on the PUA at some point. In the very most extreme case, the PUA rider itself will expire. Okay, at some point, and for the vast majority of people, there's going to come a time when base premium is the only thing the contract will accept. Well, what's the structure then? Right? There's a sense in which all policies become either base-only contracts or fully paid up. So that I just point all this out, y'all, because the language of structure carries this unspoken baggage. And as we're going to see as we progress through the course, that matters for what our rights and obligations are and what the cash value generation can look like way down the line. And because we're doing the infinite banking concept, and because the infinite banking concept is the product of Nelson Nash, we're going to follow Nelson Nash's rules, one of which is think long range. So we're thinking long range. Remember, go back to that first lecture in this series where I specified the philosophy. Right, we want to pay as much premium for as long as possible while retaining that non-mech status to generate as much cash value as possible over the course of our lifetime. Okay, and like I said on this previous slide, a lot of the considerations around what a mech is and what causes a mech influences or determines or factors into the structuring of the policy. And if we're not considering the long term, then if we're only considering day 1, we're going to result, the advisable or recommended structure is going to be different, which is why philosophy matters, which is why it was in the first lecture 2 lectures ago. All right, so to wrap up here, the idea, the first way to prevent mech status now in year 1 and in the future is by having sufficient base premium, right? Is by adjusting, calibrating the premium structure. And premium structure is referred to in sort of these strange ways, but that is what it is. This idea of a home construction metaphor, I like to say that you can think of, and I'm very skeptical of metaphors in general, but this can help. If you're going to go build a custom home, you can build one with like a 6-inch deep foundation, or let's say an 18-inch deep foundation. Well, the home with the 6-inch foundation, right, you can pour that relatively quick. It'll solidify. You can start building the structure on top of it much sooner. Whereas if you want to go with an 18-inch thick foundation, well, it's going to take more concrete. It's going to take more time, more cost. However, the structure built on top of the 18-inch thick foundation is going to be much more robust to the future. It's going to be much more, it's going to have a much higher degree of integrity, let's say. It's going to be much more stable long term. In fact, you might even be able to build more on top of that structure than if you had a structure on top of a 6-inch thick foundation. Of course, the idea of a very minimal foundation refers to, in the life insurance world, a premium structure where a relatively small percentage of the total annual outlay goes to base. Right? Base premium is the foundation of a policy. So the higher percentage of a total outlay for a given policy that goes to the base, the stronger, the thicker the foundation. And the longer we'll be able to pay PUA in a non-MEC compliant fashion. Method number 2 of making sure we don't have a MEC. Method number 1, we don't want to pay too much PUA too soon. Because too much PUA too soon will generate too much cash value. Too soon, that'll cause the MEC. We'll eventually have to cut down the PUA or shut the PUA off totally earlier than we otherwise would. So we want to make sure we have sufficient base as a percentage of the total outlay. The second way is with a term rider. So recall that the 7-pay test addresses the premium in relation to the death benefit. A modified endowment contract is one where so much premium paid in a given 7-year period can pay for the death benefit fully, right? Meaning no premium in year 7 and beyond is required. That's a MEC. Okay. Well, and then ultimately the point is to address cash value growth. Right? We don't want to pay for the death benefit too quickly because that must mean that we're generating too much value. We're generating too much cash value in the contract too soon. So one way to make sure that the value generated in the contract is insufficient to fully pay for the death benefit is to raise the death benefit. Okay, inflate the death benefit, raise the death benefit. Okay, in a sense, we're kind of playing keep away. If I do want to generate a bunch of cash value, a bunch of equity, a bunch of capital in my policy, which we do, everybody does, and we want to do so for as long as possible, by the way, while preserving that preferable non-MEC tax status, well, then how about we just crank up the death benefit? Well, how could we do that in an affordable, cost-efficient manner? Well, we can use a term rider. Okay, rider, this is an addition to a contract. It rides on top of the base policy, just like a PUA rider rides on top of the base policy. And term, just like it sounds, temporary death benefit. Okay, so term, when you hear term, you should think temporary death benefit. How temporary? Well, we'll get there. So I can add some temporary death benefit that'll be on there for some amount of time. Of course, this is going to involve a premium, right? More death benefit. Got to pay for that death benefit. I'll do so with a premium. But this is why, going back to our idea here throughout the series, I want you to understand why we do this stuff. This is why we're using term, is to get the death benefit up away from the cash value so that I can pay a bunch of PUA premium, so that I can build a bunch of cash value. Now, fun fact, just quick digression. In my view, there's probably more, I'm sure, but there are 3 major margins along which IBC-friendly companies can differ that I've noticed. And I'm sure there's more. Companies typically only offer direct recognition or non-direct recognition. They typically don't offer both. Some companies do, but mostly there are some companies that offer direct and other companies that offer non-direct recognition. As we've mentioned in a prior lecture, the degree to which PUA terms and conditions can vary is quite wide, quite broad across companies. And then the third margin of difference across companies is the types of term riders they use. Remember, there are 3 types of term riders, 3 different mechanisms, 3 different ways of temporarily increasing the death benefit so that I can pay a lot of PUA, so I can build a lot of cash value, so I can become well capitalized and become my own banker. What are the 3 types? There's not a particular order here. This is how it makes most sense to me. The first, we have 1-year term, okay, abbreviated OYT, also called annually renewing term. Remember I said term provides a temporary amount of death benefit for a certain amount of time. Well, with a 1-year term, it adds temporary death benefit for 1 year. And typically these riders these 1 year term riders will keep some death benefit on the contract for multiple years, but the amount of death benefit will change each year. Now, it's important to understand that not only will the amount of death benefit on the 1 year term change each year, but the premium, the price per death benefit dollar, will change too. Like we could assume that the amount of temporary death benefit changes year to year, but that the price doesn't. Okay, that the dollar for a premium, the price of a death benefit dollar in terms of premium doesn't change. We could assume that, and that could be the case. You know, maybe you have $500,000 in additional temporary death benefit in year one. Maybe that costs $500 in premium, and then maybe in year two, the temporary 1 year term death benefit goes from $500,000 to $400,000, and we could assume that the price of death benefit per premium dollar stays fixed, but that because the death benefit went down, so too does the premium, right? Going from $500 to say, let's say $450. Okay, understand that that's not what I'm saying. What I'm saying is that not only does the amount of death benefit change, but the price per the price per death benefit dollar also changes, right? As we get older, in insurance lingo, as your attained age rises, the premium dollar price per dollar of death benefit goes up, regardless of the total death benefit dollar amount you have on a contract. Okay, death benefit becomes more expensive in temporary term insurance over time, period. Okay. With 1 year term, because we are maintaining some temporary death benefit on the policy each year, there is a renewal year to year. Okay, so if I have that $500,000 on the 1 year term rider in year one, and then it's going to go down to $400,000 in temporary term death benefit in year two, well, there's going to be a renewal at the end of the first year into the next one. At that time of renewal, the individual's attained age increases by 1 year, and there's a repricing of the individual death benefit dollar. Okay, so there are fewer, ostensibly with these 1 year term policies, the idea is the amount of the total death benefit, so the total rider death benefit goes down. So as time goes on, the total rider death benefit amount goes down, but the premium per death benefit dollar goes up because we're getting older. All right? That's how 1 year term works. Level term. A level term rider, the idea of level refers to this word fixed. I like the word fixed, then level. Me and the insurance industry have a lot of disagreements as the terminology that accurately conveys meaning, but okay, let's call it level, whatever. A level term rider adds a fixed amount of temporary death benefit for a specified duration. Okay, so we have 7-year term, 10-year term, 15, 20, 25, 30-year term riders. Not every company will offer all of these, right? The most common ones are 10-year term, 20-year term, and 30-year term. So if I have a 20-year term rider, that'll add, say, $500,000 in death benefit for 20 years. Okay? In this case, the number of death benefit dollars doesn't change for the period of 20. It's going to be $500,000. Okay? Nor does the premium change. So it's a fixed death benefit, fixed premium. You might say, well, how does that work, Ryan? You just said that as we get older, our attained age rises, and as the attained age rises, mortality risk increases. That should mean a premium increase. And yes, that's all true. What actuaries do is they map that out. Right? They say, okay, $500,000, if we're going to put it on for 20 years, given how old the insured is. This would be the mortality risk when the individual's younger. This will be what it is when they're older. They draw that from actuarial statistics across thousands and thousands of people. And then what they do is they level that out. Okay, in a sense, with level term, you're overpaying for the death benefit earlier on and underpaying later. Right? There's a sense in which it's not a literal geometric average, but there's a sense in which they're averaging out, so that rather than paying very low premiums for this particular term product early on and very high premiums later, they bring those into balance so that the premium for the duration of the term, say 20 years, is the same. Okay, so level term, fixed death benefit, fixed premium. You can see the contrast here. With that 1 year term, the death benefit isn't fixed. The amount's supposed to go down. And the premium will go up. The premium per death benefit dollar will go up because there's renewal. Every year there's a renewal. The price per death benefit dollar can change. And by God, the companies will change it. Look, you can't do this, but if you were to renew a 20-year level term rider in 20 years, theoretically you could do that. The premium would just be gigantic. Right? That's why it is the case that level term riders don't renew. They're there for a specified duration and then they're gone. Now with level term, some of them can be convertible. And some of y'all have asked me about this, so I'm just going to say it here. Term conversion, typically term policies from a mutual life insurance company can be converted into permanent, say, whole life. Suffice it to say for now, you wouldn't want to do that. Right? Term's in place for a reason. Remember, term is preventing the mech. Term is there to increase the death benefit, to allow for a lot of PUA, to allow for high cash value accumulation while retaining that non-mech status. Okay, if you were to convert the term, you would have to take the term rider off and create a separate policy that would reduce the death benefit on the older contract, such that continued high PUA premium payment will cause a mech. So typically, a level term rider is enforced on a policy for tax purposes to keep in this IBC world, to keep the death benefit up away from the rising cash value. But you should know they can be converted. Some people have a serious need for death benefit. They're uninsurable, something medically very bad has happened. They want to maximize what goes to their people, and so they'll convert their term. That's really the more common use case. All right, that's level term. Next is, and this is the third one, I promise, is the blended term PUA rider. A blended term PUA rider combines PUA premium and 1 year term. All right, so this is one rider. You pay one premium to this one rider. That one premium is split up by the company into two parts. One part goes to pay for premium for temporary 1 year term death benefit, and the other part goes to pay for permanent paid up death benefit. Right? So one portion of the rider premium goes to 1 year term, one portion of the rider premium goes to PUA. PUA premium buys permanent paid up death benefit, right? That's what we have here on the slide. The idea is to hit what's often called a target face amount or a target death benefit. Okay, the idea is that a combination of the temporary 1 year term death benefit plus the permanent death benefit purchased in a given year together will equal this target. The target face amount is often abbreviated TFA. Real close to TSA, and there's some similarities. Okay. So that now recall what I said up here about this 1 year term. Over time, the death benefit with the 1 year term decreases, but if we want to keep the same target face amount, more therefore of this one rider premium to the blended term PUA rider will go to PUA. Okay, so with a blended term PUA rider in the early years, a larger proportion of that rider premium goes to pay for the 1-year term, and over time, a smaller and smaller portion, ostensibly, a smaller and smaller portion of that rider premium goes to pay for 1-year term, and a larger portion goes to pay PUA. And throughout the duration of however long this rider's on the contract, the idea is to maintain a same target face amount. See, a blended term PUA tries to match what a level term rider does. Level term rider adds fixed death benefit for a certain duration. A blended term PUA says, we want to keep a certain amount of extra death benefit on the contract. Yeah. We're going to target that. And the target may or may not be achieved, but the goal is that the death benefit with 1-year term and the permanent death benefit will together equal that target face amount. These are the 3 types of term riders. And here's what I think. I think 1-year term and therefore blended term riders violate the principle of insurance. The principle of insurance is risk pooling. I'm shifting my risk to an entity that is spreading it across many, many people. In return, I'm getting guarantees, right? I'm shielded against potential fluctuations, potential manifestations of uncertainty in the future. I'm protected against, because I've shifted through this contractual relationship. I've shifted the risk. I've shifted the potential price consequences. I've traded that uncertainty for a guarantee. That's risk pooling. Right? Shifting risk to somebody else. Okay, 1-year term does the opposite of that. 1-year term introduces annual renewing. Okay, annual renewing is literally the opposite of risk pooling. When the death benefit is repriced every year, if the repricing in the future diverges from the assumed change at the beginning, guess who's responsible for the difference? The policy owner. The policy owner is responsible for differences in actual future premiums, right? Actual costs for that future amount of temporary death benefit, and what was assumed at the beginning. And by the way, this is stated, and in the case study lecture 6, I'll show you an example of this. This is stated in the illustration, y'all. If that isn't violation of the idea of risk pooling, it's really close. like really close. Okay, so I don't like 1-year term. And I've written articles about this before, and it's irritated people. And I understand. And look, this is not personal. I know you watching, you may have a policy with a 1-year term rider on it. You, the agent who's watching, you may, that might be all you sell are dividend-paying whole life policies with annually renewing term. Look, if all we had were, as agents, were policies where we could add, the only type of term we could add is 1-year term, then that's what I'd sell. But that's not the case. We can establish a guarantee. We can accomplish the goal, right? The goal is to increase the death benefit, to allow for substantial cash value growth, to allow for substantial PUA premium payment, while retaining that non-mech status. We can do that with 1-year term. But in so doing, introduce the potential that the policy owner would have to come up with money in the future should the company's future mortality experience deviate from what was assumed at the outset. But we don't have to. We can use a level term rider and fix that. Literally. Fix that problem with a fixed guarantee. Like I said, at the very beginning of all this, lecture 1, IBC is a process. It's not a product. I agree. The emphasis on structure out there is murky. Has it helped people? I don't know. But the genie's out of the bottle. Half of the inquiries I get, although if someone's listened to the podcast a lot, Banking with Life, then they might know how I feel about structure already, and we'll talk about things like their financial circumstances and goals and all that, which I really much rather prefer. But the genie's out of the bottle. Pandora's box is open. People want to talk about structure. I get it. If I wasn't in the position I'm in, I was just a consumer, I'd want to know too. And so since people want to know, I'm going to tell you what I think and why I think it. And unfortunately, that is going to mean coming into disagreement with a lot of people who have done some of these agents. When I first wrote my Medium article on why I don't like one-year term, there were written complaints. I won't say who or to whom, but yeah, not happy. There were allegations that, I only sell products where we use a level term because those companies pay higher commissions. Of course, it always comes down to commissions, right? There's an anti-capitalist ethic underneath all of this, always. Maybe not always, but in this case, there certainly was. It's like, no, this is why. I'd prefer guarantees. The policies I own, well, 2 of the 3. The first one, if you'll remember, was totally mangled, but I didn't know anything at the time. The 2 more substantial ones I've acquired since have long-dated level term riders on them. Long-dated. In my case, that means 30 years. What does it mean for a term rider to be long-dated for someone? Well, it depends on how old you are. Okay, if you're 62, you're not going to get a 30-year term rider. The price would be too much. If you're 62, you might not even have a term rider. Maybe a 10-year term rider. It varies individual. The younger you are, in general, the longer dated a term rider you can get on a cost-effective basis. And again, the whole point is to raise that death benefit, to allow for high PUA premium payment. I want a very long-dated term rider so I can pay a PUA for a very long time. So I can maximize my cash value growth. So my policies have very the longest dated term riders you can get. Okay, but so this annually renewing thing, I don't like it, and I'll show you an example in a minute. This problem is magnified by blended term PUA riders where the dividend is assumed. I say assumed here to pay the rider premium. There are riders out there from some companies where, in order for the rider to be on the policy, the dividend must be used to pay the premium. I don't like that. The dividend should be going to the PUA. And you might say, well, in a blended term PUA rider, over time, more of that rider premium will go to PUA and less will go to 1-year term. And so over time, more of the dividend will return to PUA. Okay, yeah. By the way, all riders have a cost. At the company that my 2 policies are from, when the dividend goes straight back into the PUA like it should, there's no expense charge. Because there's no rider. Right? It's not a rider. The company just keeps the check. It goes to the PUA. A blended term, all riders have expense charges. And there's a fee for having these riders. So you might say, okay, yeah, over time, the proportion of this blended term PUA rider premium that goes back to the PUA increases. Okay, sure. But oftentimes, the term component is maintained, so there's still some that's going to pay for the term, and there's the expense charge. So there's no way around that. Nelson said the dividend should go to the PUA. That's where it should go. So this makes it even worse. I say it introduces another layer of uncertainty. Look, when the dividend is supposed to pay the premium, we already talked about how the premium can renew. So the changes in the future premium are uncertain. And in the event that future premium changes deviate from what was expected, the policy owner is responsible for the difference. But dividends, too, are non-guaranteed. So what if the dividend in the future deviates from what it was assumed to be? So now potentially the dividend is insufficient to cover the rider premium. In fact, maybe the rider premium is higher than what it was assumed, and maybe the dividends are lower than what they were assumed to be. Gee, I wonder if a financial institution could ever, do something like that. Look, I don't want to scare people just for the sake of it. Is it the case that there will always be a deviation in blended term PUA or 1-year term rider premiums from what was originally illustrated? No. I'm not saying that's always going to happen. Now, if you whittle the base down to nothing, if you squeeze the only guaranteed element of a premium structure down to as little as possible, you are maximizing the possibility that there will be a deviation in pricing in the future because you've maximized the non-guaranteed element of the contract. So it depends. The answer is it depends. Will this happen? Will this divergence between assumed and actual pricing occur? Maybe. And it depends. And by the way, you don't know if it will. The company might know, but they're not going to tell you. And the agent sure don't know. That's why I call it uncertainty. And I'd like to eliminate that in my own world. And that at the end of the day, these 1-year term products, be it a pure 1-year term or a blended 1-year PUA term, 1-year term PUA, they don't even get you the maximum time over which you can pay PUA. Imagine that. Imagine a 1-year term rider annually renewing term death benefit that carried enough death benefit for you to pay a PUA premium in 30 years. How old are you going to be in 30 years? Actuarially speaking, what's your mortality risk in 30 years? What's the price of death benefit priced in that year in 30 years? It's a big number. And you're telling me a company is going to tell a client that what that number is going to be and that the client's actually going to pay it? Come on. No. 1-year term riders do not last as long as level term riders do. Therefore, the amount of PUA premium, the duration over which you can pay PUA premium will be shorter on a 1-year term than it will be for a level term. And I know there's going to be corner cases. There's going to be someone who's exactly, say, 68. They've got exactly 7 years to go. And it might turn out that with a 1-year term rider, you can fit exactly as much PUA in as you could if you used a 7-year term rider. Okay, I get it. There's always going to be these special cases. Generally speaking, you're not going to get PUA premium duration for as long as you will. You're not going to get PUA premium duration for as long as you can in a level term rider with a blended or a pure 1-year term rider. Here's example time. This is an actual letter, redacted, of course. I know I look like I'm going over Freedom of Information Act documents. I redacted this myself, okay, to maintain privacy, of course. This letter is to inform the client of a recommended premium increase. By the way, this was in, I think I blocked out the date, but this was in 20. This letter was received by the client in 2020. The policy was 4 years old. 4 years old. Not 20, not 30. Policy was 4 years old. Will this happen to everybody? No. Is this an anecdote? Yes. Is this a data set, that we performed econometrically, theoretically sufficient testing on? No. But it happened. Okay, you should be aware of it. I'm just saying that this is the kind of thing you can expect with 1-year term riders. Maybe not expect. You get what I'm saying. I've added enough caveats already. My goodness. This insurance policy includes it's It's a blended term PUA rider. This letter considers a blended term PUA rider, which again, the term death benefit for which is annually renewing. And what the company is saying is, look, we recommend that the premium go up. I'm sorry, you can't see that writing, but this is a blended term PUA rider. The letter was received in 2020. The policy was 4 years old. I'm zooming in so we can see the text as best as possible. In fact, let's just go big screen. Boom. All right, so this insurance policy includes a rider which is paid by a combination of policy dividends and rider premiums. And it turns out that the current projected dividends combined with the current rider premium will not be sufficient to reach crossover. Crossover is the point where no more term death benefits necessary. Okay, so all this idea of a crossover is where the target face amount is constituted all by permanent insurance. And what this letter is saying is that given the dividends that are projected, the word projected is wrong, given the current expected dividends, and these dividends are supposed to go to pay for the rider on this policy, it turns out that we're not going to have enough dividends to pay enough premium to acquire enough permanent death benefit such that we no longer have to carry temporary death benefit. Okay, so this letter is saying, well, it looks like we're going to carry temporary death benefit for longer than we expected. Therefore, we're recommending that you pay more premium. If you pay more premium, well, then more of that can go to buy PUA, and therefore we won't need to carry the term for as long as the term death benefit for as long as we thought. Your current premium is $8,133.25. We're recommending it go up to $8,757.49. You know, is it a huge increase? Well, it depends. Depends on who you are, right? $625 or so. I'm close. $24. This is in 1 year. Annually renewing. Okay. This recalibration can happen every year. Will it happen every year? Probably not. Can it? Sure. There's no reason. There's no contractual language saying it can't. If you would like to make this recommended change, please complete the enclosed form, blah, blah, blah. And then here's your potential policy impacts, this third paragraph. You're not required to increase the rider premium to the new recommended amount. However, declining to do so may result in 1. The need to pay a higher premium in future policy years. The failure of the rider to achieve crossover to fully paid up life insurance on your specified target crossover date, the date at which the target face amount is constituted only by permanent insurance, or a reduction of the death benefit in future policy years. Now, the way this is phrased, it says declining to do so may result in one of these three things. That's the way it kind of seems. Not the case. It can result in all of these. And one of which is a reduction of the death benefit in future policy years. Again, why was the rider on the policy? To prevent the mech. And we selected a certain amount of target death benefit in order to achieve that. So if the death benefit goes down, could it be that then with continued PUA premium payment that I cause a mech? Yeah. And the company knows this. Look, you chose a specific amount of life insurance for a reason. What a clever little line. Yeah, maybe one of them was to prevent from losing the inferior tax treatment. So it's important to maintain the level of coverage you need to meet your protection goals. Yeah. You know, the client was confused by what this letter meant. And I know this has been sort of a technical lecture. We're hitting minute 75. I get it, but you can't break this up. It's too much. It needs to come all together. But the client didn't understand what this meant. And he didn't like the explanation. So, you know, how does this get managed? How does a policy like this get managed? A couple options. reduce the PUA premium. Right? If too much PUA causes too much cash value growth, which would then cause a mech, well, then one way to do that is to just not pay as much PUA. Right? That's one way to manage that. That'll, look, the cash value in these kinds of policies will be higher than the cost basis. You'll have surplus capital generation. It's all good. It's all about trade-offs. This can be managed. I have clients. Well, here's one in front of you. I have clients who come to me who have 1090 contracts or contracts with very little base and annually renewing term riders on them. I get to have the unpleasant conversation of explaining to them what they have. That's always fun. I know no one likes to make someone feel bad. But I rarely recommend replacing a policy. And so my point is they can be managed. This policy can stay in force with proper guidance. Policy owners not going to hurt themselves. They're not going to cause a mech, right? If they do, there's typically a grace period. The consequence can be reversed. Right? The trade-off is not hurting yourself or not hurting yourself. The trade-off is just the condition will always be with proper guidance, the condition will always be you're not going to hurt yourself. It's just going to be a matter of how long you have the ability to pay into your system. This is becoming your own banker. Does a banker want to be limited by how much capital he can put in his bank? Does a banker want to be limited as to how much capital he can generate in his business? Of course not. Now, we're human, we're fallen, it's imperfect, we got to deal with these modified endowment contract rules. There's going to be limitations, but do I want lower limitations or higher ones? Okay? So this can be managed, but in a sense, it comes down to principle and philosophy, and that's why we started where we did in Lecture 1. Pivoting just a bit, there's a phenomenon I've sort of noticed is that in the context of the utilization of level term, I've seen a tendency for, insureds who are young, 20s, 30s, 40s, even into their 50s, where the term rider on a new policy is not long dated, but relatively short dated. A 7-year term as opposed to a 30-year term, for instance, or a 20-year term. I don't get that. I mean, I get it, but I don't. Again, my policies I'm 29 as of the date of this recording. My policies have 30-year term on it. I have clients who are 45 and they got 30-year term. Okay, as long dated a term rider as possible in my world should be the way to go. It maximizes, and agree with me or disagree with me, but that preserves the ability to pay the PUA for as long as possible. If you wanted to pay a maximum PUA premium in year 15 on a policy with a 7-year term rider, you're causing a mech. A policy with an insufficiently long-dated term rider, just like a policy with a 1-year term rider, will result in throttled PUA. You're going to have to pull back on the PUA to prevent that policy from becoming a mech. So if you want the ability to pay a PUA for as long as possible, you need a long-dated level term rider. And like I mentioned, the caveat, you can find little corner cases where that's not the case, right? Someone who's much older, or you can hypothesize any kind of case, any sort of special, unique, nuanced case where this isn't going to hold. But generally speaking, I'll even put it on here so no one attacks me later. Generally speaking, you need a long-dated level term rider to maximize the duration of PUA premium payment. And how long-dated that rider will be is going to vary according to the age of the insured. It all comes back from Lecture 1, the goal, I want to pay as much premium for as long as possible. A long-dated level term rider helps me do that. But there's no term in becoming your own banker or building your warehouse of wealth. Now, part of that, as I explained earlier, is that for Nelson, just given his age and when he was purchasing policies, there wasn't term riders to be added. So is term necessary? And this is a resounding no. I have clients who ask me, you can think of a client, this might even be describing you. You either own or you've owned temporary term death benefit in the past. You've become familiar with the idea that you're paying for something that you'll probably never use. Of course, it provides for protection. I get that. There's a reason for death benefit. If you go, your people should be taken care of. I'm on board. But I've experienced that some people don't like the idea of renting their death benefit. They typically come to this idea as they learn about whole life and permanent death benefit, of owning your death benefit. And so they get turned off by the idea of term. I get that. I get that all day. And so I have clients who they're like, we don't want to do term. No term. Perfect. What happens when you don't use term? Like I said, you're not going to be able to pay the PUA for as long. Secondly, the proportion of the annual premium that goes to PUA is going to be lower. Okay, you're not going to get away, as of this recording, someone in their 40s, good health, a 30/70 contract. If it's not a mech day one, it might become one real soon. Whereas if we go with a 50/50, right, more premium paid to the base, a thicker foundation, right, more initial death benefit bought with the base premium. More, again, a modified endowment contract happens when you have too much cash value too soon relative to the death benefit. Well, if I have a thicker foundation, if I have more base that buys more initial death benefit, I'm already raising that ceiling on that MEC calculation. And so if I pay more of my annual outlay to the base premium, that buys more initial death benefit, and as a percentage of my total outlay, I have less going to the PUA, right? Say in that 50/50 scenario, well, now that cash value generation from the PUA may not put the cash value growth dangerously close to the death benefit. It might not endanger that tax treatment. For a lot of people, that's the case. All right? So you can get away with the 50/50. Now, you're not going to be able to pay the PUA for as long. But you don't have the temporary stuff. So it's trade-offs. Every client's different. This is one reason of many why there is no one-size-fits-all structure for every client. I'll tell you right now, my two policies, and there's other implications to structure. We're going to get into it more in the case studies lecture, but there are reasons other than whether or not however I feel about term. There are other reasons as to why why I might want more base. I'll just tell you now. All else equal, a policy with relatively more to the base within certain limits is going to show higher long-term cash values. I'll let that sink in for a moment. We'll get into it more in the future. My point is, there's reasons why you might want a heftier foundation. Right? There's reasons why you might want to pour a thicker foundation, even though you have access to all these clever building materials that'll help ensure the quality of the structure that you build on top of it. Nelson had a lot of base-only policies. He had 50/50 policies. Look at the illustrations in Becoming Your Own Banker. The structure is different across all of them. And in all of them, there's no term. Okay. So there's a sense in which I know a lot of this online can be frustrating, and that's why you have all these different assertions and they conflict. This is why I want to go through the why and what the options are, to emphasize that the decision about structure as far as which riders to use and structure as far as how to allocate the premium is going to vary person to person. But in general, is term necessary? No. You can pay a lot of PUA, not as much, but a lot. It's a matter of, does someone want, how much do they value the guarantees versus how do they feel about having temporary death benefit? It's going to change. That involves a conversation with a competent advisor. And that's why, regardless of, if term is used, regardless of the type, the client and the agent should know which one it is. Look, on my first policy, I didn't have term. I told the lady, who's very nice, I still have the policy. She's still my agent. Said, look, I read this book called Becoming Your Own Banker by Nelson Nash. In part 4 of this book, there's a policy example where of the $40,000 total annual premium, $15,000 is going to base, $25,000 is going to PUA. If you do the math, that's 37.5% of the total outlay to base premium and 62.5% of the total outlay to PUA. The structure is 37.5, 62.5. I want that. I couldn't pay $40,000 in premium at the time, but I want the same structure. She said, okay. Well, it turns out that was the structure in the first year. There was no term on the policy. And so in year 2, I couldn't pay that much PUA anymore. The structure changed. Structure is dynamic, y'all. I should have made that a separate point. Structure is dynamic. Just because your premium relationships are what they are in year 1 is not necessarily what they're going to be later on. Depends on what kind of rider you have. Depends on whether you want to maintain the Mech status or not. I mentioned earlier on a nonprofit entity, a non-taxable entity. Maybe they don't care if the policy becomes a Mech. They don't pay income taxes as it is. Maybe for a nonprofit entity, they don't even need to use term. Term's only there to prevent the Mech. If I don't care if the policy becomes a Mech, because I'm a nonprofit entity, why would I use it? Yeah. You go online and this one-size-fits-all thing, one structure for everybody, it's like, that couldn't be more wrong. I'm a fan of Jordan Peterson, the psychologist, and he talks about this idea that there's true and there's false, and then there's like the opposite of true, like the exact opposite of true, not just incorrect, but like the opposite of what's right. The idea that there's a one-size-fits-all, that one structure is always and everywhere right, is the opposite of true. And look, agree with me or not, but at least be aware of what the implications of these various riders are, especially if you are a true believer, especially if you really want to practice Nelson Nash's IBC, if you want to pay a whole lot of premium. That's another part of this idea of the discussion over structure. It's like, yeah, maybe we overdo it. Maybe it hasn't really helped. But if I'm going to pay 20, 30, 40, 50, eventually 70, 80, 90% of my income in premium, you can bet I'm going to care. So I get it. And there's not a lot of information out there on it. Hopefully this course is helping. You made it. My God, we did it within 90 minutes. Didn't think it would take that long, but it did. Some digressions along the way. But like I say, it's always a good day to digress into stories about Nelson. Next time is non-forfeiture options, NFOs, and policy loans. Here's a little preview of of 3 of the non-forfeiture options. RPU means reduced pay up. We mentioned this briefly. We'll talk about what that means next time. Premium offset, what that means. It's really a combination of what are called partial surrenders and a change in the dividend election. We'll get into that. Policy loans. Policy loans are technically a non-forfeiture option. Policy loans originated as a non-forfeiture option, but I'll tell you what that means next time. We'll go into why policy loans are so powerful. I'll make a strong claim here. Policy loans are the most efficient credit instrument on the planet, and I think I can prove to you deductively why that is. And loans are loans. Loans have interest, and so we'll talk about how policy loan interest works. So thanks for listening, y'all. We'll see you next time.